Welcome to the Dividend Talk podcast, episode 77. Does inflation even matter? Hey guys, welcome back to another episode of Dividend Talk. Today we're going to have a chat about inflation, our thoughts around it, and does it even matter? We'll also take some portfolio reviews and questions from our community. All that and more. See you on the inside. Yo, European DJ, how are you?
Well, another week with a lot of work, but I'm actually really excited because, I've got a short trip coming up. So I'm really looking forward for that. So on Sunday, I will be on a road trip. And yeah, it's almost the end of the year and all kinds of dividend hikes being announced this week. So as a dividend investor, it really sparked my curiosity again.
Yeah.
How's it going with you?
Oh, great. Look, the festive season is upon us. Decorations everywhere. We're singing songs. I can't wait. I love this time of year. It's my favorite. The kids are having a ball, and in my hometown they have this festival, and they have lights everywhere. There's like places to eat, and there's a nice atmosphere around. It's really good. So it's really lifted my spirits because honestly, work is killing me, but I'm enjoying it, and it's funny that you mentioned dividend increases because CVS, a competitor for Walgreens, so that's ticker CVS, and Walgreens, which is ticker WBA. So they're huge competitors, and CVS have finally increased their dividend. 10% dividend increase. They've increased their guidance for next year. They must have paid down sufficient debt. I haven't looked at it in detail, but it's great news. I know a lot of dividend investors have this company and they've been quite dormant for a while. It's a company that I like as well, but it's a growing dividend. I thought we have another couple of years, so it's good news. And as I said, dividend wave will really like this one.
Nice one. And it's Walgreens then also coming up, I guess, anytime soon again.
Yeah, Walgreens will be coming up soon, and they have a high target now. I want at least 11%.
Wow. Well, what caught my attention this week was actually that Intel wants to spin off Mobileye. And this is really interesting, right? Because back in 2016 or 2017, I think 2016, I was actually analyzing the EV industry a little bit. I felt like, for my 10% part of the portfolio, which I invest in growth, I wanted to look a little bit into this. I had my eyes on Mobileye, but then Intel acquired it just around the time that I really was diving into it. And I felt like, what does Intel want to do with Mobileye, right? Such a small
Yeah,
company, such small scale. It didn't fit, in my opinion. And what is the news now? Intel wants to spin off Mobileye. And you know why? To create visibility of this hidden asset in the company, because nobody really knows about them having it. Yeah, that's
yeah,
kind of the whole narrative. They bought it at the time, I think, for around $16 billion. I heard on CNBC that they're thinking that it might do an IPO for 40 to 50 billion. That would be like 3-4 fold of the investment. So from that
yeah,
point of view, the former CEO made then a really good return on investment in 4 years.
yeah,
We can't say that for most of our portfolios, but yeah, it's really interesting because in general, Mobileye is really interesting. Also, technology that it provides. It has been rapidly growing revenue, also under the wings of Intel. But I just never understood why it needs to be under Intel. I always felt like it would have been better off by itself because also it has more swag all alone, let's say, than under a
yeah.
brand of Intel.
Maybe. And I mean, they popped, didn't they, during the week because of this announcement?
Yeah.
Can I just roll back there a second? Did I hear a slight compliment for Bob Swan, or did I mishear that?
Well, yeah. Of course. Hey, if they are able to sell this again for 4 times, why not? Yeah,
I,
credits to who deserves credits.
yeah, I mean, it would be a massive return on investment, but this is such a small part of Intel, isn't it? Like it's a
Yeah,
tiny part. As you said, you hardly even know it's there, and when you're reading the annual reports, you kind of skip over it. It's a billion
yeah.
of their 1 billion is not a small amount of money, by the
Yeah,
way, but it's small in comparison to what Intel
yeah.
makes. So it
It
looks
would be
looks
like 1 or 2 years of cash flow, right?
yeah.
To fund some of their fabs. So
And to me, that's worth it. I think it's a good move, personally.
yeah, me
I
too.
I
It doesn't need to be on the Intel. Better
I
off alone.
I don't see, but we're seeing this, aren't we? Companies are just spinning off the parts of the companies that they brought
Yeah.
in and they're just not working. They're just all going back to their core.
Yeah, exactly, exactly. So it
Mm,
will be interesting also to see on the balance sheet how it works because they can retire some of the goodwill they paid on it as well. So yeah, I think it's just good for Intel. I really, really like what Pat Gelsinger is doing, and actually, he really starts to remind me how is it, Satya Nadella. Satya Nadella also took 1 to 2 years to clean up the company and to get it positioned for rapid growth. I'm actually starting to think more and more that I need to start nibbling in because before we know it, if Pat really gets the investments done, I think we can see really, really something nice coming out of it. My trust in the CEO is really, really growing. I've been reading the investor days, and I was always quite bearish
yeah.
on Intel. But with this new CEO, I've been now observing him for like half a year to 9 months. I'm really, really becoming more and more bullish. I really think he has it in him to bring Intel again back, over the next decades, right, into really good growth. Yeah.
I'm going to be biased, but all engineers make good CEOs. It's what we're built to do.
Yeah, probably. If they understand also the other part, right, of accounting and these kinds of things,
You have
and
accountants and
politics.
CFOs for that business.
Yeah, yeah.
Engineers, we build things, we fix things. That's all we need to do.
Good. Super, super. Anything else that caught your attention in the news?
A couple of things. Shell, I think we spoke about Shell before moving to the UK, so it's losing the Royal Dutch. It's going to be Shell from now on. I think the shareholders have now approved the plan to move to the UK, so that's going to be finalised. So they'll now be incorporated solely in the UK, and it will no longer be Royal Dutch Shell. And one of our friends in the Twitter group will be delighted with that.
Yes, exactly. And I was surprised, 99.7% seem to have voted on this topic, yeah, that they wanted to back the move.
Yeah,
That's really, really large. I would have expected more, I would say, controversy around this, but I think it's more politics than investors.
yeah, because I would have expected, like, do you know what, the Gyro sends out the most traded stocks of
Hmm.
the month by country, and then you have always in the Netherlands you have Royal Dutch Shell, and I always think
Yeah,
that it's just, you know fellow countrymen, and they're just being
yeah,
like so patriotic. So I would have expected this to be a little bit tighter. I would have thought you'd be saying,
yeah,
hold on now, we want to keep this company over here, but
exactly.
there must be, as you said, politics or,
Yeah, but these are institutional investors. The Dutch pension fund already started to pull back from this because they don't want to invest in dark black oil again
mm,
anymore. So, anyway, who cares? I think it's good for the company, simplification, hopefully more dividend growth. That's what really counts for me.
yeah.
Okay, yeah, the last but not least, and that's also maybe a nice jump to the main topic of today. Inflation rate came in today in America, 6.8%.
Mm,
Enormous, enormous. We
yeah,
haven't seen this since 1982.
yeah.
I mean, it's crazy when you think about it. It's crazy, really crazy. And I just wanted to talk a bit with you about like what does it mean for you when you hear this, and maybe also in relation to what we do as dividend investing, our portfolios. How are we going to catch up with a 6.8% dividend? Inflation rate.
I mean, and it's not just that it's 6.8%, it's how fast it went from almost zero to pop, and it's at 6.8%.
Yeah.
It's how fast, because usually if it increases steadily, we'll adjust, and the
Hmm.
Fed and the guys that do the money business can adjust. There's no adjusting here. It just kind of pops straight out, and we knew this was coming. I mean, we've been reading annual
Yeah.
reports, we've been reading 10Ks,
Yeah.
10Qs, we've been reading everything, and they've always had inflation. So look, it can't be a surprise to investors, but does it influence your, like, does it matter? Will it influence your investing behavior?
So I don't know yet, to be honest. First of all, what is good to clarify, this didn't happen since 1982. I'm from the early 80s that I got born. I've never experienced such inflation rates. I think that's really important to mention. So I've never navigated these waters like that.
Yeah,
I can only look back at history, what people did at the time, but that's something different than having felt it, than going through the emotions of this. So things that come to my mind now, for instance, are also like, will I get a 6.8% salary increase next year? And even more, because I would like to grow my salary above the rate of inflation, right? So I've got these things in my mind. At the same time, I've got in my mind, okay, but for my retirement, I'm assuming, I said, an annual dividend growth, organic, of 6%.
mm,
Yeah, where I assumed the 2% inflation, so 4%. So what it really means for me to keep on track for being able to cover my expenses, I would need to have a 10.8% dividend, I said, organic dividend increase over the next year to compensate for this. No way that's going to happen. I just can't imagine that, specifically not with half of my portfolio.
yeah,
So, but to be honest, I don't know what else to do. I'm not competent when it comes to trading in gold or something like that.
yeah.
I don't think there's really an alternative here.
But like they say, gold is your hedge against inflation and commodities. But would you make that sufficient return? Do you make at least 6.8%? I don't know. I don't know,
Exactly.
but I find it hard to think that you would.
Yeah, exactly. So I rather think it, how is it? It won't. So I think I will just need to take it on the chin this year, because
Yeah,
I really think there's no alternative. And what what I do appreciate about dividend investing, that if, for instance, the interest rates will be hiked quicker, it will really compress growth stocks, I think, more. I
yeah,
think because
yeah,
they have been exponentially being inflated because of the zero interest environment. Money costs nothing, but if money starts to cost something again, I think we will see growth stocks being hammered. And we have seen that already over the last few weeks, right? So from that point of view, I do think that dividend stocks provide a little bit more stability in that, because we invest for income,
yeah.
not for price appreciation.
Yeah, because growth stocks, their future earnings, that's what they're priced on,
Yeah,
isn't it? Their future earnings. And if their future earnings are going to be worth less,
yeah,
then they have to suffer. They have to come down. And we're starting to see that. Like,
yeah,
it was only 12 months ago when you couldn't go onto Twitter and everybody was a growth stock expert. People moved
yeah,
from dividend stocks into growth stocks, and all sorts of names come out. And now all these names are getting crippled because of inflation fears.
yeah,
And I think it's only a matter of time before we start to see some of the bigger boys up there starting
yeah.
to suffer with this, because I think these figures will, like, 6.8% will spook investors. I think a lot of investors will be spooked about this and start to take money out, I think.
Yeah, and also, interest rates hikes and such that are
Yes.
coming up. So what it means for me is, I don't see an alternative than
Yeah.
continue to do what I am doing. I think there are some companies in my portfolio that will be able to outpace the rate of inflation, and that can pass it on to the consumers, like Microsoft and Apple. They have really strong positions. But for instance, Unilever, I'm not so sure about that. They are already in the consumer goods, and I think they depend a lot also on the more people on lower incomes, yeah, for
Yep.
a large part of their sales. And I think you can't just easily hike your product prices with 7%. Yeah, because it hurts them twice as much. And I know that actually food has been growing really hard, like beef, for instance. I think
Yeah.
it grew inflated 25% in a year or something like that.
See, well, you've got two arguments there. So you've got inflation during good times, and that's
Yeah,
when you have more job growth, and there's more money coming in, and people can spend more money. And in that scenario, you might see the likes of Unilever being
yeah.
able to pass on their
Mhm.
costs. We're not in good times, so we're
No,
we're we're,
exactly.
we're now in inflation in difficult times. So it's not spurring on job growth. So people are not going to have that. So Unilever could, they could by all means go and increase everything
Mhm.
but people might not have the money to buy that, and that's where they will suffer.
Exactly.
And I
Yeah.
feel the same with, like, if you look at real estate investment trusts, I think it's a similar scenario. Now I know some of them are
Mhm.
involved in more industrial, but if you look at ones that are like involved in mortgages and housing,
Vonovia. Yeah.
like, how do they pass that on to their it's very, very hard, because people just don't have that money, and you start to see evictions and you start to see all
Yeah.
sorts, and then they lose that rent. So
Yeah.
I think REITs would struggle in this kind of environment as well. Certain REITs, not all
Yeah.
REITs, not all.
So it feels a little bit like we just need to take it on the chin. We had not a lot of inflation over the last several years,
Yeah,
so maybe it's just a matter of catching up. But I don't see it stopping quite quickly. I think if you look at the current circumstances, there's so much liquidity in the market.
yeah,
We're coming back to normal after the pandemic with all this stimulation also from the governments. I don't see it stopping unless the governments really, really draw back their how is it? Yeah, their funding of society effectively.
yeah.
But what then will happen is like all this liquidity will move out of the market, and so anyway, I think we are kind of at such a time in history, probably what Ray Dalio is always talking about, that we are towards the end of the debt cycle, I
Yeah,
think. And nobody knows when it will be. I think makes really powerful arguments. So I can imagine that over the upcoming 2-3 years we might really see this return to normal, which means maybe no growth, or even decline in portfolios.
yeah.
But that by itself, I'm really happy with, because it has not been easy as a dividend investor over the last few years, except for those 2-3 months at the start of the pandemic.
I feel like if that happens, all our social media platforms will be a quieter place, just like the crypto. But I mean, at the first question I asked you was, will it change your behavior? Okay, and you say no.
So yeah, no, but I might look at some companies if I deploy new money
Yeah,
that find it easier to pass on
but
on
but
on the inflation
but
card. Yeah.
at the moment in your portfolio,
I'm not going to sell anything.
I know I'm not going to
Yeah,
ask you going to sell anything,
yeah.
but you're quite aware of the companies you have, and
Hmm.
in particular, you have a cost or a fair value on them. You base
Yeah.
this on a discounted cash flow, which takes into consideration inflation. Will you have to go and change all this now? Because
No, because actually I stopped doing that. So in the past, I was looking at the weighted average cost of capital,
hmm
and then a company has 6% or 7%. And then if there's inflation, you need to start looking, considering that the interest rates will go up, and those interest rates then define your weighted average cost of capital.
yeah,
But I started recently always just to plug in a 10% discount rate as the expected annual return that I want to see. And this is a little bit, how you say it, inflation agnostic. It is just, how you say it, that the growth that I might foresee is not based on real, I said, adjusted growth, because some of it will be eaten up by inflation. So in itself, not. But yeah, I could easily do that by adjust my expectations to what the discount rate. And this is why you will see a lot of prices decline if interest rates really get hiked, because
yeah.
it means that the cost of capital becomes more expensive. Everyone will reevaluate their cash flows, discounted cash flow models, and that's why usually the target prices go down, and then the markets go down with that as well. So you have a really good point, but on how I'm applying it, not necessarily, no.
Okay. No, that's good, because it's one of the questions, and it's probably one of the reasons I've stopped doing discounted cash flows, because I'm just not experienced enough in them, and
Mhm.
you're making all sorts of assumptions that honestly it's way over my head. So I prefer to let the experts do it, and I follow them, and use something that I
Yeah.
can understand. But no, that's good to know. Um, but in terms of your portfolio, then, like, I think is it Peter Lynch or is it Ray Dalio talks about this all weather portfolio to weather all storms. Do you feel like, I don't know, I honestly don't feel like that. My portfolio is well diversified, but how do you feel about it?
I feel my portfolio is well diversified enough. Yeah, definitely.
Hmm?
and I know it from looking at the statistics. But don't forget that I also own a house, and actually the most of my net worth is probably still in the house.
Okay.
Yeah, and this house I think is more inflation resistant from that point of view. So from that point of view, I think if you look at my total wealth, I'm pretty well positioned. From a portfolio, well, my in my top five or my number one is Microsoft, and
Yeah.
that's one of the companies I think will thrive under any environment. So I'm pretty feeling okay with it.
So your house is inflation resistant. Does that mean you have a fixed rate mortgage?
Okay, so no, not on the market rates. No, no,
Okay.
but I've got a low mortgage,
Yes.
really low compared to the value of the house.
Okay.
So I don't expect any issues there as such. The main question is, and this is my question for you: do you think your salary will grow with 6.8%? And I know we are looking at U.S. inflation rate, but we have something similar in Europe. What are your expectations around your salary?
Mine will not grow. Do you know what? It will grow close to that, but not 6.8. I'll be just under that because based on the last few years within the company, it's reached a certain level and it stays there, which is typically about 5%. I can't
Mhm.
see them going anywhere above and beyond that because let's face it, their costs are going to go up as well. So they don't want to increase wages at the same time.
But are they able to pass on the cost to the client?
I don't think so. It is a
Okay.
highly competitive market, and
Mhm.
we play with some of the big boys. Johnson Johnson is one of them that we play
Yeah.
against. And I mean, in the market that we're in, we get complaints back. We have to go and analyze what
Mhm.
has gone wrong and so on. The big boys don't do that. They just send out more of the product that, that we
Yeah.
supply, and they forget about it because their market cap is way above and beyond ours. But
Yeah.
I honestly I think it's just too competitive for them to do that in this current market.
Okay. But that means that in principle, your earnings power will decline probably then
Yes,
next year. And would that mean something for you also when it comes to investing? Will your savings rate decline then?
my possibly possibly, and this might be one of the. I'm not going to. I'm not going to say it's a bad thing, but we're living off one income now, like we said. So if our expenses go up, that means our savings have to come down, or my wife has to go get a job, and we're not going to do that. So it possibly could. The more interesting question for me is around the mortgage because I do have a variable mortgage rate. It is low in historical terms, but we do know historically that mortgage rates can go up to double digits. If that happened, I would have to really consider whether I just put all my money into paying that off as opposed to
Mhm.
investing because it would make no sense in in
Yeah.
in paying and not paying off a mortgage and earning something that I would be better off paying a mortgage. So that's the
Yeah.
real question for me.
But that would only be if the government decides to increase the interest rates because
Yes,
of, how is it, trying to slow down inflation.
yes, and which could happen. And there's been a lot of talk about this before, particularly in Ireland, that we could start to see it ramp up to maybe 7 or 8%. And I would really have to analyze my portfolio to say, okay, because at the moment I think it's around 4%. I'm
Yeah,
unlucky. I'm on one of the higher end in Ireland. Bad timing on my half
yeah.
behalf, but that's where I'm at. But I still my portfolio outweighs that, so it's not too bad.
Okay,
But
so hypothetically,
yeah,
let's assume that it would be 7%, your market rate. Would you then, for instance, sell your whole portfolio if it yields only 3% to pay off the mortgage and start all over again?
well, I don't know if I would sell, but what I would probably do is right now I overpay on my mortgage X
Hmm.
amount, and pay I pay more into my
Yeah,
portfolio every month. That might shift. I might swap those. I might still
yeah,
build my portfolio because I would really hate to sell, but I would definitely start paying off a little bit more over time.
yeah,
But if we start seeing 10, 11, 12% mortgage rates, then I would seriously consider selling to,
yeah.
to bring down that rate.
And can you lock in, how I said, can you lock in the interest rate now for the upcoming 5 to 10 years?
Yeah, we can lock it in for 5 years. We could lock
Okay.
it'd be slightly higher. I must actually check that and see what it would be. I,
Yeah.
Ideally, I would like a lower rate, but I have I have this thing called a split mortgage when I went back to
Yeah.
college. So I'm in a little bit a little bit of a unique situation. I'm trying to remove myself from that with the bank. I've been, as I said, overpaying, and I'm trying to get off the split mortgage
Yeah.
to lower my rates. But it just might be bad timing for me. So I might be
Yeah.
in a situation where I have no choice but to stay on
Yeah.
a variable.
Well, I think over here in Poland we would be in deep shit, because housing prices in Warsaw are really high.
Mm,
Many people need a lot of mortgage, and if that would go from, I don't know, from two to 3% now to 10%, I think many people would be screwed. It would really lead, and it would just it would just result straight away in an economic crisis. I think, because it means like people need to pay up for the flat that they're living in, can't spend anything anymore on
yeah.
other stuff. It would be really an economic crisis. I can't imagine anything else.
Uh,
I don't think we will see that, by the way, the 10% anytime soon, right? I really don't think so. We're still at almost zero interest everywhere. So to hike that, it would need 20 or 30 hikes. Yeah, I can't imagine that in a year
yeah.
or two or
Uh,
three.
yeah. But you never know. Drastic measures can happen. So it's just
True, it can. But then
y-
we would have economic crisis, and then
yeah.
they would need to lower interest rates again to
Mm,
fuel the economy. I mean, that would be, but that's what I mean. We never lived in such times, right? Then we go back to the end of the 70s and early 80s with 10, 15% interest rates, which would be, I think, really uncharted waters for all of us as investors. And I think it would really depress the share prices, and it would be a perfect environment to buy dividend stocks.
but I think it would.
If you would have money for
Yeah,
it.
yeah. If you have money, but it will shake out. It will shake out the majority of these would
Yeah,
be investors. So what you will have left is maybe a percentage of hardcore investors that
yeah,
may have been sensible enough to keep money aside, have a war chest, and institutional investors. The rest
yeah,
will lose money, and we've seen this in the past. And by the time they get back into the market, all the gains are gone.
exactly,
All the
exactly.
big boys scoop it up. So
Honestly, I can't wait a little bit for this. I'm still in the accumulation phase, so it would be for me better now to have such an environment and then
yeah.
to stash in the money at really depressed prices than when it happens when I'm in early retirement.
Mm. But and you mentioned would I sell? If we see prices drop, I would hate to sell my portfolio at a loss,
Yeah,
and that would be a huge factor for me because I would not want to sell because I know the prices will come back. Well, history
yeah,
I don't know, but history suggests
yeah,
that the prices will come back. So if I was at a loss, I'm so stubborn, I will just leave it sit there and wait
yeah.
because I could not bear the thought of selling at a loss.
Yeah, well, it's really interesting, right? Last 5 years, you could have just thrown money literally at the wall, and you would still make
Yeah,
a profit.
yeah,
Yeah, in such an environment, if inflation rates would impact interest rates, we would still need to see this all, of course, right? But if this all would happen, it becomes really a different kind of climate that none of us really has ever experienced.
no.
And that's really, I think, where Buffett says, like, only when the tide is low, you will see you swimming naked. Yeah. So I think it will be a mess. But we are a lot of speculation in our conversation. I think also the 6.8%, I mean, makes us talk about 10% interest rates, right? I
Yeah,
just want to also, for the listeners, for me, this has a probability of less than 1% to seeing that within the next 3-4 years. Yeah.
yeah.
So just to be clear, but it is a good discussion to have, I think, um, because I think it's still on many people's mind, inflation. And 6.8% is real now. I don't see either how we can easily make such a salary increase. Yeah. Because I'm thinking about that. I'm more thinking about my savings rate. And then
Yeah.
I've got the stupid tax change coming up that we spoke about last year. I might, if I wouldn't get a salary increase, I will probably lose 15% in earnings power. If I take
Wow.
the new tax changes plus a 7% interest rate,
Mm.
I would lose 15% in earnings power next year just
That's
by this.
that's a huge amount.
That's a huge blow in the
Mm,
face. Yeah.
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 Oh, okay. That's I mean, 15%. If I was to lose 15%, like I know you have your war chest, but 15%, then surely you have to pull back on what you invest. That would have to.
No, no. I now buy ready fries in the bag. I would then just buy potatoes and cut them myself. Hey, come on, we are frugal and dividend investors. There's always a way to save money.
I should have known. I shouldn't have known. But hey, no, I mean, this was a good conversation. As you said, it just gets you thinking about it. As it has a 1% chance of happening. Can it go to 10? Everything's speculation. We don't know. We haven't lived through it. We're not experts. There's probably listeners here that know inflation way better than us, and I would love to hear your thoughts on what you're
Yeah,
doing with your portfolio and how you will navigate it. But for us, it's going to be sit back and see, and hopefully we're not swimming naked when the tide goes low.
no, and nothing wrong with swimming naked. By the way, it can be quite
Liberating.
joyful and liberating. Yeah, I know some great, wonderful lakes in Lithuania and also in Bulgaria at the sea. It can be really interesting there.
Okay, I think this is a good time to move on to our portfolio review.
Yeah, yeah, yeah.
Yeah.
And that's a really nice one because Jeffrey met,
Mm,
really nice guy on Facebook. He's really, really active and engaged. He submitted his portfolio last week, and he shared his top 10 with us. But let's stick to the top five for this section. So
yeah.
his biggest position is Microsoft with ticker MSFT, 9% position size. Then Apple with 6% position size. I will skip the ticker there. But then the ticker NEE from NEE from Nextera Energy with 5%. Then Unilever with the ticker UL with 5%. And then Visa with 5% as well, ticker V. So that's his top five. And I was just wondering, what are your thoughts about this?
I mean, I don't think I have to ask you. The way Microsoft is number one was enough enough for you.
Yeah, of course.
I looked. It's a very, very strong top five. Even looking through his top 10, it's quite strong. I think he focuses on quality, and that shows. Microsoft, Visa, Unilever. Um, Nextera Energy is the one company I'm not too familiar with, but to be
Mhm.
honest, looking at these other companies, I'm be pretty sure it's probably a top quality company as well. I think it's a solid portfolio. He did mention he's got over 25 positions, like 3% in Alibaba, which has killed him. And he also bought CCL, which is Carnival, uh, for its 4% dividend, which they've now cut. I feel your pain. I didn't buy them for the dividend, but I have them because of the wheel strategy on my options, and I own 100 shares, and they just keep dropping and dropping and dropping. It looks like I'll be holding them for a long time, but I mean, I'm quite impressed with that portfolio. Top quality companies. The only one is Disney's not a dividend growth stock anymore, but the rest of them, I
Yeah.
think they're perfect.
That's in generally, at least the top five is a relatively low yield if you would take the average yield of the top five. But I
Yeah,
think there's really high quality growth behind it. And all of these are not massively overvalued. I think if you look at Microsoft, Apple, Visa, they are probably all around 20% overvalued. The Unilever, I think, is around fair value. So this is also not a portfolio that will suddenly go in half, these top five, if
yeah,
there is an issue with the stock market, right? So I think, like you say, really high quality. And I think based on your time horizon, Jeffrey, I think you're really well positioned with this portfolio. You also mentioned later on that you have ExxonMobil, Pfizer, and realty income. I think that gives you a little bit more of the high yield, low growth. But it's nice that your low growth, high growth, low yield is in the top five rather, because those will be the ones pulling your portfolio
yeah,
forward in the years to come.
yeah. No, it's nice, and it's nicely diversified as well. There's a nice mix. There's a nice
Yeah,
mix there.
yeah, yeah. And he says he's been looking at industrial lately, industrials. I think companies like Honeywell, Siemens, and such. I don't find them well valued at the moment. So I think it will be really hard to find decent industrials at the moment to invest in. Or you need to think about Lockheed Martin. It's personally a stock I'm staying away from. I don't want to have to do a lot with the defense industry. maybe that one you could consider. But otherwise, I think industrials, it's not the time to buy now. The time to buy is when they are at the bottom of the cycle, and they are now probably more at the top of the cycle.
Yeah, it is a cyclical industry, so I think European DJI is right. There is opportunity. I'm personally in Lockheed. I think they're incredibly undervalued, but there will
Yeah.
be more value to come, I would imagine.
Yeah. Good. So Jeffrey, good job. Thanks also for having the courage to share it and have it on the podcast being discussed. But you're doing really well, I think.
Cool. We'll move on to some listeners' questions. I think we have a few of them, so we'll get through them as quickly as we can. The first one is from Maurice, and he said, "What do you think about the bucket strategy?"
Yeah, so this is Maurice, also from Facebook. He's also a really nice, engaged guy, and I had to actually ask him what is it. So he shared a link with me, and the bucket strategy is effectively a strategy, and I tried to, I said, phrase it in my own words, where you fill the first bucket, then the second bucket, and then the third bucket. Now, the first bucket that you need to fill is like having 2 years in cash and cash equivalents there. So when there will be a sharp market crash or something like that, you would lose all your dividend income. You still can survive, let's say. So 2 years in bonds and all these kinds of things. That would be the first bucket. And the second bucket would be like if you need income from a 2 years to 10 years horizon, you would typically invest in dividend companies, in blue chip companies that pay a dividend. And then the third, once you have that filled, you go more or less to the third bucket, and you would focus more on growth stocks long term that will give you really the wealth with a 10-year plus horizon. Honestly, I like the bucket strategy a lot. When I saw it, I think it's a really nice and conservative way of managing money. Personally, I don't. I'm doing this. Let's say like I'm actually doing this. I've got my emergency fund. I've got a war chest. I can live
Yeah.
on this probably for a year. But I wouldn't need it. I wouldn't need 2 years cash and cash equivalents because I've got way more confidence in my portfolio. I think my dividend income would not be cut 100%. Maybe by in the worst and worst depression, maybe by 40 or 50%. So I would need a year then. Let's say it like that.
Yeah.
So I don't need so much. And I also am investing, of course, 90% to dividend blue chip stocks. But the other 10%, I'm actually investing in dividend growth stocks. So I own some Facebook, some Google, some Alibaba, as an example. So I think I'm kind of doing this already. I'm just not filling up the bucket by one.
Okay. So and this is saying you fill up bucket 1, bucket 2, and bucket 3.
That's what I understood from it, but I might be wrong there, right? But that's what I understood from it. I
Okay.
guess you can do some things in parallel as well. I think it's not so strict in the theory,
Yeah.
but that's generally I think the philosophy behind it.
Okay. Because usually that's what throw me a little bit. Is usually you do the growth stocks in number 2, and then use your dividend stocks for income, and that's probably what's after throwing me a little bit on that. But
Mhm.
it seems like a decent strategy. I don't personally follow strategies like that. I have an emergency fund, and I just invest in some
Yeah,
stocks, and that's about as far
true.
as I go. Okay. Forward Dividends has asked us, besides Ian Lopak and Rusty Ram, which is Dapper Dividends, what are your favorite podcasts or YouTube channels you listen to or watch on dividend growth investing?
So not much on dividend growth investing. But what I like more recently is Everything Money. It's on YouTube. I think they have a daily show. It's more for value investors. I like it a lot. But you know, it is a simple approach. They use some rules all the time. They only look at the data, and it annoys me sometimes that they say like, "Oh, hey, 3 years ago they did a major acquisition. What could this be?" And they are clueless, and they're talking about Bristol Myers, and everyone that opened up the front page of Bristol Myers know that they bought Celgene. Yeah, so and these guys are promoted as making managing 100 million or something like that. So I love their process, but sometimes I think like, guys, at least if you discuss a stock, then I mean, if you see so many companies, you should know at least that they bought Celgene, right? So that's the only criticism I have there. Um, Another podcast that I like to listen a little bit to, and I was also once on the podcast, is Joni Talks, but he's
Mm.
more talking about just personal finance topics. So it's not necessarily dividend growth investing. So that would be also a second shout out as a podcast. How
Okay.
about you?
Uh, to be honest, lately I have not had much time. I do watch Dapper Dividends and I watch Elo Poke. I have subscribed. I watch you when you come out. But that's about it. And sometimes I scroll through and find videos
Mhm.
that pop out of me, but I don't actively follow anyone. Hopefully over Christmas when I get a bit of downtime, I will start picking up a list. There was a couple. There was an Irish one that I used to listen to, and it's the name escapes me right now. But I will try and link to it. That was another one I listened to, but other than that,
And
time.
congratulations on your first video on YouTube. So I know you published it on the Dividend Talk account, your
Yeah,
portfolio review, and I must say I really liked it, and I would like to give you kudos for the courage also to put your face there because I want to stay anonymous. So really, my kudos, and you really have a great voice for this stuff. So I just would really like to encourage you to try more of that.
yeah. I mean, I know we speak a lot of well, we talk about a lot of topics that sometimes it's okay in podcast format, but when we put it on YouTube, we could really put a little bit more visuals. So I might take some of them and dissect them and put some visuals and try go from there. It was a new experience for me, so I'm glad it seemed to go well. I got a lot of positive feedback and I got some constructive feedback, which I expect no less from this community. I love honesty, so as I said,
Cool.
honest feedback is good.
Super. Hey, the next question is from Nineyok, and he mentioned that Pfizer announced a 2.5% increase of the dividend. What are your thoughts on that? Also knowing that they did a spin-off, of course.
Yeah, but I mean, they could have done way more than that. They've earned so much money, didn't they, because of these vaccines? It's incredible how much. And in hindsight, honestly, I remember speaking about Pfizer in one of our episodes before vaccines were even coming out, and we were looking at them, and you just knew they were going to make so much money off this, and I still just looked away. It
Yeah.
just annoys me, and I can't remember if you said you were going to buy them or that you have them or somebody wrote to me and said you're stupid not to buy them at this time. And
It can't be me. I don't own
honestly,
them.
I was they're right because it was obvious what was going to happen. It was
Well, let's
really
be
obvious.
honest. In my opinion, right, unsalted, for me, Pfizer is a poorly managed company, and they had to win the jug. I mean, they got from BioNTech, they got the vaccine handed to them. Yeah, just
Yeah,
because they even ignored this company in the beginning. If you read back to it, so they just won the lottery with this cash flow. I think they now use it more to clean up the balance sheet and everything, but it's not a well managed company from Big Pharma. So I'm not surprised that it only does a 2.5% increase. But of course, there's a spin off, right? People were thinking about
yeah.
a dividend cut actually. So I think they did really well.
Okay,
Uh,
but yeah, but I mean, I know that poorly managed, but we knew this money was going to be handed to them on a plate.
yeah.
Uh, and their share price was going to it almost doubled, I think, from before it started. So
Yeah,
they've
but
done.
dividend income is just up 2.5%, right? Remember, as
Yeah.
an income investor, that's
Oh,
more important for me than price.
I mean, as an income investor, it's awful. 2.5%. I
Yeah.
don't. I know they had to spin off, but I think they've made so
Yeah.
much money that they could
Yeah.
have at least rewarded us with more money.
Exactly. Next question from our friend Thiago Diaz, and he's asking how many dividend payments we had this year.
Oh, I counted this before. What was it? It was 90. You were two more than me. Was it 94?
Yeah, and I had 96
Yes,
indeed.
90. I had 94. Yeah, and I
I
had a.
should make 100 this year.
Yeah, yeah. I might be close to 100 as well.
Yeah, really
But
interesting.
and it's not something I thought of before, so it was interesting when you asked the question to go
Yeah,
and look.
it's the most used statistic out there, of course. But this tell me one thing: I need to do 100 line items of for the tax form calculation because I need to calculate every dividend that I receive back into Polish zloty, and I need to take the currency from the day before, and based on that, I need to submit my dividend income. So yeah,
You'll have a busy weekend ahead of you, so you might as well get it.
yeah. Well, anyway, it is like it is.
Okay. A question from Finn Twit Sub. Thoughts on ASOS versus Boohoo?
I have no clue what it is.
They're two online. They're like online shops. Um, the ad for Boohoo is quite popular over here, and they always have like
Boo-hoo.
it's. I will show you a video, but they always have kind of I would say models are women that look quite good, so it's
And they
always
call
a
them
popular one.
Boohoo.
Boohoo.com, yeah.
Boohoo.
Boohoo. Yeah. How about the second part of the question? Philips or Bayer?
This is a hard question, right? I think from a valuation point of view, they are both attractive, but I would go for Philips. Bayer has, as long as the CEO is there, uh, so I would go for Philips. But I'm not convinced by this CEO from Philips at the moment either, with his how he's dealing this. So, but I would still go for Philips.
Okay. Bayer, there's certainly an opportunity there. We think, and it once they get all their troubles
I'm
aside.
waiting for 4 years
Yeah.
already. So
Yeah, but if you only start now, you might not have to wait as long.
that's true. Next one is from El Eva. He is asking about Apple as a dividend stock. What are your thoughts on that?
I mean, they pay dividend. They grow quite healthily, and it's low starting yield. It depends on what you want, but it's a great company either way.
Super. Then Dividend dot exe is asking about whether we consider a more growth-oriented portfolio as well on the side of our dividend portfolio.
I mean, you've spoke about this. We know you have.
Mhm.
I don't really. We've just said that growth stocks are going to be crushed by inflation, so I'm going to stay.
No.
I'm joking, but no, I have already got my dividend growth, and then I have some
Yeah.
options trading that I do. So I have enough.
No. The next one is from President 2012, Mr. B, and he's asking anything on Bouygues buying and Quants. I think this question is done on particular to make us struggle with the pronunciation. Anyway, it was more a question for you.
Well, I'm sorry to disappoint, but I'm not saying those names. I did Google it. I was there. I have no clue who these companies are, but I don't have anything on. Boo, you guess.
Bouygues. Sorry, we don't know. Sorry for that. So next time we'll try to have a better answer. The next one question is from Fire Pete, and he's asking about our opinion when we have stocks where the government is a big shareholder, for example, Orange France.
I mean, when the government is involved, you have two things. You've got safety that this company is not going to go belly up. Okay, so you have that safety, but then they can stick their nose in where it's not wanted as well. That's what I feel.
Exactly. I prefer them to stay away generally.
Yeah,
Government should be fixing the sidewalks, not my portfolio.
but unless it's going to benefit me.
Yeah, well, okay. You know what kind of people work there, right? In general, without
Yeah.
disrespect to some of the listeners. Russ Knopf is asking, so from Dapper Dividends, he's asking, what's your favorite dividend portfolio tracking software? Any that are free?
There is one actually on dripinvesting.org now, and I think it's called div.io. But if you go on to dripinvesting.org, we know that's a great resource. They have an online tracker there, and it's quite good. The only annoying thing is it does tell you the upcoming dividends, what's due, and what's coming up. But I would like to be able to just click that button to say that I've received them. You have to still add them manually. That's my only gripe. But it's to me it's a good software. I think I post links of it in my blog as well.
Yeah, so I like Wallmine the most. I tried my portfolio as well, but it's just not like with all those trackers, it works well for US companies because they have all the data providers, not for European companies. So otherwise, it's just Google Sheets is my favorite one. And I've got a tracker on my blog. If people are interested as well, we'll get the link when they sign up. But for European investors, it's just hard. Just the same like a proper dividend screener. It's almost impossible to have a really good one.
No. Okay, and last but not least is from Phil, and he has asked us, when you look through earnings or annual reports, or when you listen to comments from management, which buzzwords annoy you the most?
The first one is anything that is adjusted. And the second one is when people start to talk about optionality.
Optionality, very good.
Ops- yeah.
Yeah, no, go ahead.
Last time we saw balance sheet optionality. I mean, what does this mean?
What does that even mean? I'm just saying adjusted or who was I was reading I can't remember, was it Medifast or someone like this, was reading through their annual reports, and it's like they just post all positive stuff and ignore anything bad that ever happened. So like
Yeah.
it just bugs me, like, and you're going through the numbers, you're like, you're not telling me the truth. Why won't you just say what?
Yeah.
You don't have to paint the rosy picture all the
But
time. And
this is why I'm so annoyed also with a company like IBM. They do the
yeah,
same. It's
but
always great, best year ever.
what they do is, and they don't tell lies. They flip between reported and adjusted depending on which one does better. So
Ah,
they're not technically lying, but it's not coherent, like, and it just really bugs me.
yeah, painting the grass greener than this.
Mm.
Well, yeah. You can hear already that we get annoyed from these. The question is working. Hey, I think this is the end of the listeners' questions section, and thank you everyone. And really interesting questions again, really thought provoking as well. So thanks for that. So maybe to end off the show, I would like to really give the floor to you. Tell us, what's your stock pick of the week?
So there's a stock that I will probably buy this week or will be this week or next week, actually next week, because of their dividend, and that is Enegas. So we know I had these in my portfolio before. I had them. I held on to them. I sold cover calls in them. I held them for the bones of 9 months. Got assigned and missed the dividend, which really bugged me. Now, look, I made some premium, but I probably would have made more off the dividend. So I'm going to buy them because they're going ex dividend. I think it's on the 17th or maybe before. We'll buy them just beforehand, and I'm going to grab some of my juicy 8% yield back that they owe me.
Super.
But look, Enegas, we know what they are. They're a Spanish energy company. They have committed to a floor dividend for the next 2 or 3 years.
Yeah.
You know, there's pressures in Spain. I genuinely thought that the share price would go down and not up. It seemed to have went up. It's found a floor around 20
Yeah.
euro. So, but I will still, I think I will buy them, and it should bump up my end of year dividend to over the 2,000 mark as well.
Super. Thank you. Well, welcome back then as a fellow shareholder by that time.
Yeah. So it'll be. Do you know what? I was so bitter over that I got. I got called away, and then they got called away just before ex-dividend date, and I had no time to buy it back, and I lost. I held them for 9 months and did not get that 8%. It's just, oh my god! Like, so
Shit happens, but it's never too late to recover from that again, right?
no,
So,
it's
exactly.
you take a risk, you reap what you
Exactly.
sow. You reap what you sow.
Exactly. Super. Well, hey, thank you everyone for sticking with us so long on this podcast. I know we don't have the typical 20 minutes to 30 minutes podcast, so it's always hanging out here, but I hope it's entertaining also for a full hour. And yeah, guys, I wish you all the best with Christmas shopping, actually, because I think we're all thinking about that now. Don't pay too much for stuff. You can better put it in dividend stocks. It's creating your real wealth. But yeah, have a good week and see you guys all next week. And EMF, thanks again for this great conversation also about inflation. It was really interesting to hear your thoughts. And you too, don't spend too much for the Christmas, and see you next week.
See you all next week.